Hey everyone, my name is Jeff Horton. I am the Global CLO Research Analyst at Barclays, based in London. I want to thank everyone for coming out such late in the day. I know everyone really wants to go around the corner to the lift bar, but I think we've got a really great set of panelists here today to talk about a subject that a lot of CLO managers, CLO investors have talked about for quite some time, and we'll continue to do so. But before we jump into things, I'm going to let our panelists introduce themselves. Joe?
Sure. Hi, good afternoon. I'm Joe Rotundo. I am a senior portfolio manager with Invesco. Our bank loan group manages $40 billion, and I'm responsible for the CLO business.
It goes? Okay. Roberta Goss. I am with Pretium Capital. We are a $15 billion alternative asset management firm with about $12 billion invested in real estate and $3 billion in corporate credit. I run the CLO platform, which is about $3 billion in size.
Hi, Chris Long. I founded and serve as CEO of Palmer Square Capital Management. We currently manage about $11 billion in assets focused entirely on corporate and structured credit. And obviously, in conjunction with this, I sit on the CLO investment committee for the firm, and we've issued a variety of transactions, including static CLOs, typical reinvestment deals, as well as CDOs.
Hi, Don Tran. I'm from Angelo Gordon. I'm the CLO structure at Angelo Gordon. I also oversee a portfolio of about $800 million in loans in the aerospace and defense, paper packaging, and markets. I also sit on the investment committee of our European business. Angelo Gordon is a $38 billion alternative asset management company started 32 years ago by John Angelo and Michael Gordon. We have two strategies, real estate and credit. In our performing business, we're about $7 billion in AUM. 4.6 of that would be CLOs, comprised of 8 US CLOs and 1 European CLO. We've been a CLO manager for about 22 years.
Hi, Amir Vardi, Credit Suisse Asset Management. I am, like Don, responsible for the CLO issuance at CSAM and also oversee a portfolio of CLO tranches. We have about $60 billion AUM.
Awesome. Thanks, everyone. So today's panel is titled, What's in Your ARB? So for those in the audience that don't really know what this term means, we're referring to the CLO equity ARB. So essentially that difference between what you're making on the underlying assets versus what you're paying on the CLO liabilities. It's a huge topic in our market. A lot of people like to complain that the equity ARB is challenged, and it's always challenged. But managers find ways to make the equity ARB work, and they find ways to make it work in different ways. And that's really what we're going to focus on today. A lot of these managers have different ways to make that ARB work, both on the asset and liability side. And so that's what I really want us to focus on today. So it's easy to complain, but I think it really helps to kind of dig deep into these portfolios, to get an idea from these managers' perspective on what they can do to make that equity ARB work today. So to kind of jump into, I guess, one of the more recent topics that we've been talking with investors recently is this increase in loan downgrades that we saw all throughout last year. That really doesn't help with the rating space test that you find in CLOs. But then also last year we saw an increase in repricing supply in the loan market. So these loans that are cutting coupons aren't really helping the weighted average spreads test that you find in a CLO structure. And so these kind of competing factors are working against each other, and again, isn't really helping that equity ARB picture. But again, managers are figuring out ways to make that work. So I'll start it off with Don Hua to kind of discuss how he and his team kind of think about the market environment today.
Sure, Jeff. So if you take a look at the data, we tend to have a higher spread portfolio than the market, about 380. And our WARF is actually at market, if not below market. You certainly can't do this by just being an index buyer. I mean, it's going to be very difficult. So step one is really being very selective. You know, we pass on 80% of the new issue calendar out there. We keep our diversity score to about 65 to 70. That's a very reasonable level for us. And frankly, we pass on a lot of loans. You know, we'll take a look and see if we get compensated for the leverage, the business risks, the ratings, and really the credit profile. And if you're not compensated, you know, if you're getting a B3 at 350, does that really make sense? So we'll pass. And then really the second thing that we're kind of known for is that we have a sweet spot in smaller, broadly syndicated loans. So facility sizes of about 350 to 750, you know, you get, it's a lot easier to analyze these credits. They're not big conglomerates. You actually get access to management. You can call them on a monthly basis. They tend to be less levered. They tend to have better documents. And guess what? They also tend to pay a little bit more. So those are kind of the two things that we look at amongst, you know, a number of different other things.
Good. Anyone else on the panel kind of want to talk about, again, how you guys are dealing with these downgrades, especially as repricings kick up?
Yeah, in terms of downgrades, we have seen quite a few downgrades in 2019, and we've seen a little bit of that trend continue into 2020. If you're familiar with Invesco, we're a more conservative manager, so our WARF scores are typically in the first quartile. So we have plenty of cushion to absorb downgrades. However, the overarching goal of all of us here is to be ahead of the trend of credit deterioration. So one way that we do that is we run highly diversified portfolios, and we focus on the large liquid end of the broadly syndicated bank loan market. And the objective is to trade out of names before we see deterioration. So that's another way that we manage the overall trend of downgrades. But one other thing about arbitrage that I wanted to bring up, you can work on building up the weighted average spread of the portfolio, but another factor that's really important is cash management. And what I mean by that is CLO managers have to be very careful about the amount of cash that we have in the portfolios. And to put it into context, if you're running a cash balance of 100 basis points, depending on your weighted average spread, that's equal to 3 to 5 basis points of spread on the entire portfolio. So keeping a close eye on cash balances is really important, number one. And then number two, when it comes to new issue loans that are not yet funded, one thing that we really focus on is pushing the agents to get those new issue transactions funded, because if they're not for a new issue, if they're not funded, then we're not earning any interest income on those loans. So we'll be having discussions with our banking counterparties to work on getting new issue loans settled on in a timely basis.
Yeah, I would just add, we run portfolios at Pretium that are sort of somewhere in between the conservative and with Invesco and the slightly more aggressive in terms of spread levels that Angela Gordon runs. We do run in the 340 range spreads right now, with WARFs in the 2600 to 2650 range on average. We do pick up some incremental spread, like Don said, in some of the sort of $400 to $750 million sized BSL transactions. We don't think we're giving up a huge amount of liquidity in those size of loans. There's still pretty decent liquidity even after a potential credit event has taken place. But over a cycle, you can pick up 25 to 50 basis points on any given name in that size. And and we tend to be very active in our approach. So turning our portfolios on the order of 30% a year, and constantly trying to make portfolios more efficient in terms of making sure we're paid for the B2, B3 risk. And we seem to be pushing up against that limit right now with some of the repricing activity we've seen.
You know, just to add on, maybe taking a slightly different tact, at Palmer Square, we really haven't been all that affected by loan downgrades. We have a higher quality bias, a low wharf, but I think the part that maybe hasn't been covered is we're very particular about deal timing when we issue deals, and also the structure by which we do it. And I mentioned earlier in my intro, we have 3 tools in the toolkit, so we don't just rely entirely on our reinvestment style platform, because there's times when you can't start with enough excess spread and you have to reach, and we don't want to do that. So when you look at the way in which we've approached this environment, we've actually had more upgrades than downgrades, and we don't have very much in the way of loss pressure. We've had a little bit of compression for names that we've really wanted to stay in, but by and large, we have a lot of cushion with our tests and can easily manage to that. So the last part I'll mention, it's kind of interesting that Jeff, I think, chose a mix of managers very well. Each of us kind of shares some things, but other things are different. And I'll kind of talk to one of the things that you just said, which is one of our core philosophical beliefs is maintaining liquidity, and in a high-priced environment like this, staying up in quality and being able to trade actively to help yourself with the portfolio. But if things don't change from here, we're okay with a lower IRR to our equity. We want to maintain the flexibility that having liquidity in the portfolio and an ability to maneuver provides for us.
Amir, do you have anything to add kind of on how CCM views this? I mean, is it kind of similar to anyone else on the panel, or do you guys kind of view positioning slightly differently?
I mean, the only thing I'd add is, we just care less about what the rating agencies say than what our own credit analysts say. So if they've gotten things just so wrong with, these downgrades, most of the time it's something that was rated B2. It really should have been B3 from the start. They believed all the synergies the company said or the sponsor said they're going to have. They didn't come to fruition, then they downgraded them to B3. Should have been at B3 from the first place. If they hit those synergies, upgrade to B2. So we just don't care as much. I'm sorry if there's some in the room, what they say. So our WRFs are a bit higher just because we're not focused on it. So they're, call it 2,900. As far as, triple C downgrades and so forth. We try to avoid credits that get downgraded by picking the right businesses, but we're less concerned about the actual rating specifically.
Got it. So we kind of focus a little bit more on the asset side, but I'm going to hand it back off to Chris. Chris, I think one of the strategies that Palmer Square kind of comes to the market with, and we're seeing more managers come to the market with, is these kind of shorter or static deals to help out with the liability side of the equation, right? How does Palmer Square kind of view that, in terms of your strategy overall, but then also kind of helping that ARB equation, if it does?
Sure, yeah. So for those of you unfamiliar with the concept of a static deal, think reinvestment deal, but take out the reinvestment period. pretty straightforward, but it's worth saying. What does that do? Well, it shortens the deal dramatically. So you end up with a weighted average life of 2 years or less. And for that, your cost of liabilities are substantially cheaper. So for the ARB, we've seen consistently now across about 14 transactions, a 40 to 60 basis point advantage on the AAAs, which obviously translates to a huge pickup in ARB. The other way we do handle the ARB, and it's not necessarily I would say a popular one among managers, but by charging lower fees and taking a lot of expenses out of the deal. because that also is a drag to the equity. So if you really think about the track record and your performance over a long period of time, if you have a day one NAV that's 91, one payment and you're in the black and you're on your way to making a really, really nice return. So that's been our take, and there's obviously different, things you could push back against on that, but it's allowed us to maintain our investment strategy and not reach and change our stripes just because the environment changes.
That's a good point. And I guess from the rest of the managers up here, I'm guessing there's probably a lot of focus on, I guess, refis today, right, in terms of managing that side of the liabilities?
Yeah, we assign quite a bit of value to the optionality that a refi provides. It's a great way to reduce the weighted average cost of the liabilities and improve the arbitrage by really not incurring any additional portfolio risk, or you really don't incur any additional portfolio risk with a refi. And then another big benefit of a refi is and this is really somewhat market dependent, somewhat manager dependent. The other benefit is changing and modifying some of the terms and conditions of the OM and the indenture. So for example, in most all of the refis that have been done year to date, they've included weighted average life test extensions, which becomes very valuable in the last year, and especially in the last 6 months of the reinvestment period, because with the weighted average life test extension, you can continue to buy new issue bank loans with ease, which does add quite a bit of value to the CLO and to the arbitrage.
So another way that I think managers have been trying to look at, improve this arb equation is kind of a mixture of deals that kind of go outside the regular bounds of what a typical CLO would allow for in terms of limitations. And so one of those type deals has been these kind of high CCC deals. Now, we obviously don't want to spend too much time kind of delving into the mechanics of such or whatnot, but I mean, it's a strategy that some managers are definitely looking at, I think, to help that equation. So I think, Donwa, you had a few points on how Angelo Gordon kind of thinks about this, right?
We like to call it enhance, not CCCs. But look, because of our distress history and really our experience in the CLO market, we've really looked at this. We've been approached by underwriters and investors. Just a quick summary for those of you who are less familiar with the CCC or enhanced deals. Think about a portfolio of loans. Typically, you have a 7.5% limitation on CCCs. These enhanced deals give you up to 50%. That's a very large number. I'll touch on it in a second. And up to 12% in second liens when the basket is 17.5% in second liens when the basket's about 5 to 10%. We've looked at this, and what we found is that it's a very interesting product. You can be a buyer in downgrades. You can be a buyer in dislocations. You could tag along to distressed funds. You could tag along to credit opportunities funds. And then when you kind of step back in today's market, the median CCC and CLOs are actually just about 3% versus that 7.5% test I touched on. And then when you rewind back to 2008, it was really just 12% median exposure in CCC. So it's not as impactful to regular way CLOs. However, nobody knows what the future is going to be. So we do find this product extremely interesting. Now, to go back to that 50% limitation, it does seem extraordinarily high. We think 30, 35% basket in CCCs is very reasonable. And what you could also do is actually create a structure where there's a step up. So let's say day one, you only have 5% CCCs, your cost of capital is X. And then when there is a dislocation and you want to buy more CCCs, why not have it X plus 50? 50 is probably a little low, but
in terms of, I guess, the rest of the panel, I mean, how are you and your teams, higher level firms, thinking about I guess triple C's as being part of that ARB equation today. So maybe not necessarily an enhanced deal or whatnot, but how are you thinking about triple C's in general, especially a lot of the media has kind of grappled on to this how triple C's are held in CLOs, and there's been a lot of kind of misconstrued headlines in terms of reporting that CLOs said to be forced sellers of triple C's. Like, how do you guys think about triple C's today, especially in terms of the kind of ARB framework?
Well, I was going to say on the moniker or the brand of CLO, if it's triple C or enhanced, I don't know that it's enhanced CLO. I think the jury's out, so we'll see at the end of the day if they are enhanced relative to regular CLOs. But it's nice to have the flexibility, certainly, if there's a dislocation. And I think in this market, if a manager stays, I think to Chris's point earlier, with relatively high prices, notwithstanding today's market action, I think staying kind of higher in quality and waiting for the dislocation, being patient and hoping that during that 5-year period you'll have a chance to kind of buy triple C's at very favorable prices. There's something there. It definitely requires the right manager and the right equity investor and patience, because kind of going full boat right now, it seems like that may work, but it seems like there's certainly a lot of downside to it. On the other point, since you brought up some headlines, I think there was a Bloomberg article about the swap non-discount obligations at bankruptcy exchanges. So I just wanted to touch on that, because those are things that have been in deals since before pre-crisis. There's nothing new about those features at all. So I don't know why that story was written, but if you just think about like swap non-discount obligation, basically if you have a CLO that bought something at par and it's trading at 60, and the manager thinks there's further downside, they should sell it. But they might be incentivized not to do so because they're going to burn 40 points of par, and if they want to make that back, they could buy something at 81 that gets par treatment. But they might be incentivized not to do it. But this feature it kind of fixes that incentive problem. It allows the manager to go and buy something, sell something at 60, go buy something else they think is better. It has to be at a higher price. It has to have a better rating, same or better rating. So it's sort of like fixing that incentive problem. I think all investors should want managers to have that flexibility. Debt investors included should want managers to do what's best for the deal. If you think that's a trade that's going to improve the quality of the portfolio, you should be allowed to do that. So that's what that's doing. There's also caps in terms of how much you can do. But I just wanted to sort of dispel that one.
Yeah. One thing I'd like to add to what Amir said is, well, first of all, our investors want us to have the ability to swap, to enter into deep discount swaps, and I think most CLO investors want their managers to do that for the reasons that Amir mentioned. The other thing about triple C's, I think there's a little bit of a myth out there that CLOs have to sell triple C's. I've read that, I've heard that a number of times, but CLOs are not forced sellers of triple C's. There are consequences to breaching a 7.5% triple C basket. Number one is that once you're above 7.5%, you can't buy more triple C's because we have to maintain or improve any tests that are failing. And then the second consequence is the triple C haircut, which basically means that you have to mark the excess over 7.5% to market. So that has a negative impact on your OC ratios, but in some situations you may be willing to accept that and live with that given your long-term view on recoveries of triple C's. So anyway, the main point is that CLOs are definitely not forced sellers of triple C's, although there are consequences to owning more than 7.5% triple C's in a CLO, assuming that your limit is 7.5% and not 25 or 50%.
I'm going to touch on some boring math to follow up with Joe. So if you think about a CLO has a 4% OC cushion. You assuming that your triple C's are all trading at 50 cents on the dollar, you would actually need 15.5% exposure to triple C's to actually fail that OC test, right? Because it's 7.5% and then 8% excess, and then 50% of that. And that's greater than the median in 2008. So I don't think, I think most of these journalists are just trying to scare folks in terms of the triple C language.
If you happen to burn through that 4% OC cushion, that's also not the end of the world. The deals are designed to redivert cash from equity to buy more assets or delever. That's okay. I think roughly half the deals during the crisis missed at least one payment. That's okay. Those deals ultimately did fine. That's what the structure is supposed to do. So to the extent that that even happened, it's also not the end of it, and it doesn't cause forced selling. It doesn't, so.
Now, kind of on the same point about CLOs being able to hold triple C assets, or having this non-discount swap obligation language. Are there any other kind of steps that you think are useful to have in the docs that allow you a little bit more flexibility on the asset side of the equity arb equation that don't necessarily affect the liability side that much? Obviously. People will talk about like post-reinvestment type language that may affect liability pricing. There's a lot of discussions around reference rate replacement language, affecting liabilities. Does anyone have anything specific?
One that we don't think is often talked enough about is your discretionary trading basket. It's set at an arbitrarily, in our view, low level. Typically 25%. We had a hard time as we've canvassed the market figuring out why that is. And as we shared about our strategies being more of an actively, more liquidly, more liquid traded type approach, that's important because rather than have to game it and call it credit risk or whatever the case may be, we've been big believers. So we've actually been pushing in a lot of our transactions to have a much larger discretionary trading bucket, and we've succeeded on that, which is nice. So we're hoping more and more people in the marketplace will. So that's my plug for that. So,
I mean, thematically around CLO debt investors like to put handcuffs on CLO managers in various different ways, and as a large CLO manager, we like to have the flexibility to do what's best for the portfolio. But we also think that the debt investors should want us. So if you pick a manager that you think is good, that you like, you should give them the flexibility to do what is best for the portfolio to protect your investment, because it's a credit investment at the end of the day. As far as reference rate language, there's a lot of talk about LIBOR replacement, and there's various different forms of that language. From my seat, both as an investor in debt and equity, and both as a CLO manager, we have no interest in arbing the debt or having some mismatch. I think a functioning market is what's best for the market. I think our equity investors also are of that view and want to do what's best for the market and have a orderly transition. So as far as reference rate and sort of playing games and trying to arb the debt, I'm not saying that that's not out there per se, but it's not. I don't think it should be in most people's interest. It's not in our interest. We'll do what's best for. We have been putting in language that is acceptable to everyone, and we'll fix the older deals to the extent that there still are some older deals that don't have language by the end of next year.
So I think one of the steps that's slowly but surely making its way over to the U.S. We see a lot, especially in the European CLO market, is the inclusion of negative screening language for ESG criteria. Obviously, it has a little bit less effect in Europe because there's not as big as, say, like oil and gas exposure over there. But in the U.S., it can definitely have an effect, I think, in the future in terms of like for asset pricing. It doesn't seem to really affect the liability side of the equation yet, but Greta, what are your thoughts, Roberta? What are your thoughts on maybe ESG affecting both sides of that equation going forward?
Right. So I think I would start by saying that all of our clients, and I think that anybody in this room would be hard-pressed to say that their clients are not focused on ESG as a topic. And every DDQ that is coming through, be it an SMA, CLO, debt and equity investors, all are questioning what our policies are for ESG. And I think that is only going to increase in terms of profile and requirements. We have started on the corporate credit side at Pretium to score every credit that's coming in with a proprietary rating system from 1 to 5, starting out in a fairly simple way to determine what our ESG risk is within the portfolio and start to monitor it on a real-time basis going forward. On our real estate business, it has become very front of mind. So our investors want to know what we're doing in terms of managing the homes we own and how we are upgrading them and painting them and running trucks. So I think over time, the corporate credit business is going to be very focused on ESG as a factor in the companies that we invest in. I don't think right now it is impacting, as Jeffrey said, the cost of our liabilities, but I do think it will going forward, and I don't know when that inflection point will happen, but at some point, I believe that CLO investors who do not have a robust ESG policy will be, there will be a cost to that. Last week, we saw a CLO announced an ESG focused structure where 50% of the loans in the deal would be ESG compliant, and by that they meant that those companies would have less than 50% of revenues exposed to either I think it was largely environmental and socially restricted industries. And those are, as you would expect, sort of oil and gas, some gaming on the social side, tobacco, alcohol, and now cannabis, although I haven't looked at a cannabis loan yet. I think eventually, and I think we've started to see it in some of the loans that have had issues. If you look at the coal names, some of the prison names, I can't point exactly to ESG being the factor in terms of them holding prices down, but I think that people are thinking twice about buying those industries as they have encountered some problems. And I think going forward, there certainly will be a valuation cost to ESG companies going forward. Unclear when that inflection point is going to be.
No, I just start with I completely 100% agree with everything you just said. I think that was very succinct and to the point. I think what's going to be most interesting for the market is how robust is the language going to be in some of these documents as to those definitions and calling yourself ESG compliant, because there have been some deals done so far, and it's pretty light. It's pretty light. I mean, I think all of us could probably issue one of those tomorrow and comply with the same language that was put into those deals. So I think that helped those folks get deals done, maybe. But longer term, it is going to be something that, in our house view at Palmer Square, that affects spreads. It will be something that affects spreads. It's a real movement, and we think it's exciting. We think it's really good for the overall market.
Just 2 data points. So before coming to this panel, CSAM we're in a room doing a bunch of meetings with investors. I probably had around 10 meetings prior to this. I think all but one brought up ESG and spent 10 minutes or so on it. So that's just an interesting data point. I also agree that it's going to have meaningful impact. I think there's going to be a point where equity investors are going to really want to do ESG, not because they care about ESG, but because there's so much ESG fixed income out there that's trying to find investment opportunities, and by making a CLO compliant, it will allow those pockets of money to buy the debt, and you'll have better liability spreads, and you'll have better equity arb, even adjusting for maybe some assets that can't be included in there. So that's how I think it's going to play out.
Yeah, from what we're seeing, ESG is really gaining quite a bit of momentum. We're getting a lot of inquiry from our investors on how we rate ESG. Number one, and then number two, right now we're running two different portfolios that are ESG funds, and we're seeing tremendous interest because more and more investors are focused on ESG and want to see more ESG portfolios in the bank loan space.
Well, I can't say nothing. So, no, we brought in a firm called SASB to educate all members of Angelo Gordon, particularly on the front office, about ESG. And what we've done actually outside of just the investment process is actually within Angelo Gordon, how do we comply and think about ESG? So we've actually gotten rid of bottled water. We've built a women's council. We have a diversity council. So it's not just ESG in your portfolio, but are you living ESG in your day-to-day? So that's one thing. And then the way we think about it is, do we want to be the ones policing ESG? Do we want to put the 1 through 5s, or should it be, I'm not going to say Moody's and S&P, but could it be another independent agency that could do that so that everybody has roughly the same scoring system? Because I could have a different view of oil and gas than Amir. And I'm sure that'll happen, or coal, or anything, or defense. You know, I cover defense, and that's a big topic now. Is protecting your country good or bad? We have planes, we have missiles. Is that good or bad? So that's still a big TBD, and there's a lot of work still to be done.
All right, well, before we get into the last 10 minutes or so, I wanted to ask if there were any questions in the audience. Kind of liven things up before we get to the last 2 or so questions.
Yeah, I just follow up on ESG. If you guys could talk a little bit, I know you mentioned a little bit about how you guys did it at Angelo Gordon, but I'd love to hear from others. Like, how are you going about implementing it? Are you doing it at the firm level or just in your portfolio? Are you hiring an outside consulting firm to come in and do that work, or are you designating an ESG officer within the firm?
Yeah, I can start. So we have exactly done that. We have designated an ESG officer.
Oh, sorry, maybe
Yeah.
add, like, where within the firm does he fit? Is he on the investments team? Is he on the marketing team? Or is he completely outside of the business?
So he is within our legal team, but sits in on all of our investment committees. So he is the one that is questioning the analyst on, is this really, because with the 1 to 5, you end up with a lot of 3s, and trying to push more dispersion among our ratings. So we have not gotten to the point where I feel we have perfected our scoring system by any stretch of the imagination, and we've really only started the scoring system in the last quarter. Another thing that we are contemplating doing is signing up to the UNPRI, it's the United Nations Principle for Responsible Investing. And I think this goes to Chris's comment, it doesn't really cost you anything to sign up. I think there have been 2,500 companies that have signed up, but it doesn't necessarily mean that your ESG investing is as rigorous as one would think. So we are contemplating signing up for that. We have engaged counsel to determine what our policies, how they can be enhanced. And then practically, we have also gotten rid of all the plastic bottles from our meetings and within the office. And as I said, we own 40,000 individual homes in the country. And we have, when we upgrade them after purchase, we're making sure that the appliances are environmentally friendly, the paint, when we're painting houses, we tried to push that as extensively as we can in our real estate business. Our inspectors' trucks, when they run, we're trying to buy electronic cars. So we're trying to implement it across a firm-wide and as a firm on that basis.
So the first thing I'll do tomorrow is get rid of the water bottles. Didn't even think about that, so thank you.
It was actually a client who came in and said, what are you doing with these? That was the trigger. So.
I appreciate the heads up. We will take care of that. But no, well, that was a serious note too. But on another serious note, what we've done, we've started with a mission statement. I know a lot of people kind of poo-poo that stuff, but that was very important to us. Is actually why are we doing this? And then we did do the UNPRI signatory. I agree. It's not a lot of teeth to it necessarily today, but it's moving that direction. There's going to be a lot of reporting, and I think they're doing all the right things to hold people accountable. So we want to be part of that accountability. We have designated 2 people, one on the operations side and one who's a portfolio manager. We've fully incorporated it into our investment process already, and we have a scoring system. So we've done a lot. Now, have we brought a product or solution to market yet that is, deemed ESG compliant? We have not. We're still grappling internally with what do we want to have the Palmer Square name on, and that needs to be something that we'll be very, very proud of. And so we're still working through that, but we feel like we've got all of the initial building blocks in place so that we can put something into the market that we're really excited about.
Anyone else? Good.
Our ESG person is a he also, but he is our head of research, and the reason that is because he's able to push down the criteria. We have a scoring system. It's been in our, I think it's about 2 years that we've been incorporating that into our credit memos and so forth, but it's also in conjunction with Credit Suisse, which is a very, very large effort and a lot of people.
Cool. Well, then just kind of one last question for our managers, and it's going to be a little bit more higher level one, but I really just want to get everyone's takes on kind of, we discussed different ways that a manager can add to the ARB today, whether that's helping on the liability side or the asset side. But I'd love to just kind of get everyone's takes. What ends up helping that ARB kind of going forward from here? I mean, so we talked about ESG. Some managers are including these things like mascots or AMRs, different mechanisms to maybe attract newer type investors. Some managers are choosing to make their deals European risk retention compliant to add to the investor base. I mean, really, what else do you think you can do yourself to kind of help with that equity ARB, or is it just going to be a natural decline going forward, and there's not much else you can kind of do in the meantime?
I'll start off. I think making deals European risk retention compliant makes a difference in the arbitrage today. At some points in time, it really doesn't matter, especially if the market is really well bid. But what we have observed is that the bid for risk retention compliant junior mezz tranches, triple Bs and double Bs, has been strong for EU compliant deals. So we're seeing more and more U.S. investors who do manage EU compliant money, so they need securities that are EU compliant. So that's number one. But just a bigger picture comment on arbitrage is that, and this really proved to be the case in 2019. We're thinking a lot on this panel about arbitrage, but the other really important factor is preservation of principal value and being very careful about stretching for yield. And we've seen that happen where deals that seem to be attractively priced and have a strong external rating. When you really dig into it, they have a weak credit profile. And if you look back on 2019, there's quite a long list of names that have blown up or have traded down 10 or 20 points. So credit, at the end of the day, credit selection is really paramount.
Yeah, and I would agree with all of Joe's comments. We are making our next new issue European compliant, just to broaden our investor base in the liabilities. We generally own all of the equity in our CLOs that we issue, and we have been really since the beginning of the year lost about 10 basis points of spread across our portfolios, and not prepared to stretch to either maintain what they were at the beginning of the year. We think we're at a point in the cycle, wherever that is, but with the downgrades we've seen in the last year, it's all about the credit underwriting you're doing, and that might result in a slightly lower equity return for our fund, but that's what we're prepared to do today to preserve capacity down the road when opportunity exists.
I think the single most effective way to increase the ARB would be if there's just less issuance.
Yeah.
Less managers, less new managers, less issuance overall. Because if you think about it, if you price a CLO, you're creating a supply of liabilities, you're creating demand for the loans. So when there's $120 billion of issuance last year, $130 billion the year before, $120 billion the year before that, you just create a lot of supply liabilities, you create a lot of demand for loans. And CLO debt is cheap. I think most people recognize CLO debt is cheap. There's just been so much issuance. So when that slows down, and it's when, it's not if, so at some point it'll slow down, issuance, ARB will get better because spreads will tighten, because there's less of this stuff just being created. That's the number one thing. The innovation, AMR, the mascot, some of the features, that's all good. This market is usually pretty slow to innovate, but I'm definitely in favor of some of those things. Mascot's good, AMR's good, but more things like that would help the arbitrage.
I'm actually going to go with you need more buyers of CLO tranches versus less issuance, because I've always actually thought about why are CLO debt, why is it not on a bond index? Like if it was on a bond index, there'd be a whole different list of buyers. Also, the CLO market has been, it's kind of young in a way, and it takes time for different firms, different shops to hire the 1 to 5 person team to monitor CLOs. Sometimes there's just one person covering CLOs, CMBS, ABS, so that person may not have enough time to, look at every manager. And then when you specifically kind of think about ARB, subordination does help. If you have flexibility in subordination, at the bottom of the stack, if your double Bs are 7.5% subordination, that means there's more leverage. If you increase that to 9, sure, it's going to be a different cost of financing. Same with the AAAs, right? Whether you're 40% par sub or not. And then another thing that we found is that so in the CLO space, there's a lot of CLO managers that also invest in CLOs in the secondary market. And if this manager has a high overlap to your portfolio, it's going to be a whole lot easier to, get the secondary improvement. So if you have, reasonably high overlap with the liability buyer, sure, that CLO will likely qualify. And then generally, I think a lot of folks here have touched on just marketing. Look, you're always out there. We fly to Asia to meet a lot of investors twice a year. We go to every single conferences because, there's new investors every single time. And so you're always talking to the buyer base, and that really does help.
I'm more of the view that we've had 10 years of robust issuance. I think we've sort of turned over every stone. I hope you're finding new investors, Don, but I do think it's kind of, This market's pretty mature at this point.
All right, great. Well, thanks everyone. I think we're a minute over time, but yeah,
really do.
have a good day.